Hi, Luke Fannin here from AIT's Business Faculty, and we're looking at audit reports. And this is the second, I suppose, video on this or screencast that I've done. The previous one just looked at Glanbia's audit report for, I think, the year ended 2018. Here we're just going to look at some past questions, or how to answer past questions in relation to this topic. So most questions you're going to get a number of scenarios, so maybe for a 20-mark question there could be 4 scenarios is usual, or five scenarios, and you then have to indicate with reasons the kind of audit report or audit opinion that you would issue. And so to do that, you need to know the rules in relation to audit reports and how you come through it. And it mentions it quite nicely here. It says materiality considerations, accounting principles and standards. So you need to be able to consider those issues. So if we look at how to answer a question like this, generally you will have to go through these steps for each scenario. Establish if there is an error or a possible error with the financial statements, and I'll explain that in more detail. The possible error is a limitation of scope issue. Establish if they're immaterial, material or pervasive, and then the effect on the audit opinion. So in some of these scenarios there isn't actually anything wrong, an error, or there isn't any possible error in the financial statements. So then if that's the case, then the statements are correct. And also, if there is an issue but it's immaterial, then that means as well the financial statements are correct, or the financial statements are true and fair. So what we're going to do in just this screencast is look at where the financial statements are true and fair, where there are no errors or no possible errors, or if there are any, they're immaterial. And what that means is it's a non-modified, UN unmodified audit report, which is this one. And a non-modified opinion means the accounts are true and fair, and I'll give you an example of that. Here's Glanbia's audit report for 2018, and in our opinion the financial statements give a true and fair view. That is an example of an unmodified audit report or audit opinion. Everything is okay with the accounts. We've nothing to report, no problems or potential problems or issues to report. So however, it's not just as easy as that, because the accounts may be true and fair, but oftentimes the auditor may need to draw readers' attention to certain important matters, so we need to go down through these. But unmodified audit report means, in the auditor's opinion, the accounts are true and fair, and often the auditor just issues that. And that Glambia report was an example of that. Just, in our opinion, the financial statements give a true and fair view. That's unmodified, and that's everything okay. However, for some reasons the accounts can be correct, but the auditor may still want to draw readers' attention to important matters. Maybe to stop being sued, or as well, but it's also to provide value and to let shareholders know that there are important issues they should read. They have been accounted for correctly, but they should look at them. And so the auditor does this by adding a special paragraph to the audit report. And there's about 4 ones, or three that you need to know. And then so the first one is an emphasis of matter. So the accounts are true and fair, but basically read our emphasis of matter paragraph. And what this does, it tells readers that something important has been recorded correctly in the accounts, or is disclosed correctly in the notes to the accounts. And an example of that is here. This is the Anglo-Irish Bank accounts for the year ended September 2008. And in our opinion, the financial statements give a true and fair view. So that's an unmodified audit opinion. But if we look to the right here, they have here emphasis of matter. Now they have ES, so it's more than one. There's 2 emphasis of matter. Quite apt in relation to Anglo-Irish Bank. But at that point in time, the auditors believed the financial statements gave a true and fair view of the accounts. And then they said, informing our opinion, which is not qualified, so it's unmodified. They're basically telling the shareholders to read note 1.1, which explains how they had to restate some of the figures in the accounts. And that's an important issue that they just want to draw readers' attention to. And the other issue is note 53. So they're telling shareholders, read note 53 concerning ongoing reviews by external bodies. And they're saying it cannot be determined. And that's really an emphasis of matter. So it's just an extra paragraph below the opinion, but the opinion is still, in the auditor's opinion, the accounts are true and fair. And then, but please read note in the Anglo-Irish Bank example, it was note, I think, 1.1 and note 53, which discuss important issues. So here's an example of a scenario in a question. Kylie's a substantial claim lodged against the company major customer, and they're saying it's fully explained in the notes to the accounts, but no provision has been made, as it's not possible to determine with reasonable accuracy the amounts which may be payable. And also there's legal advice which appears to be reliable that the claim can be successfully defended. So the auditors have to consider here, should a provision have been recorded in the accounts? So should a current liability have been created? Debit expenses, credit current liability for X amount. And a provision should be recorded, but it needs to be probable. And so here it doesn't seem it's probable that they'll have to pay out because it looks like it will be successfully defended. And also a provision can only be recorded if it's possible to determine, with reasonable accuracy, the amount payable. So on two strikes, on 2 points, it's not possible to create a provision. So to answer this question, you'd have to explain the issue here is about should a provision have been recognized, and it wasn't possible to recognize the provision because it didn't meet the probability or the probable criteria or the ability to estimate the amount with accuracy. So therefore, the company have done the right thing and explained the matter in the notes to the accounts. So therefore the accounts are correct. So the answer in this question is, and you'd explain the accounting issue like I discussed, then you would say it's probably material because it's a substantial claim and it's a major customer, so it should be disclosed in the notes to the accounts. So the accounts therefore are correct, so it's unmodified. So in our opinion, the accounts are true and fair. But to show that you know what an emphasis of matter paragraph is, you might then in your answer should say the auditors may add in an emphasis of matter paragraph where they will say, please look at note 26 to the accounts, which discusses a claim which has been lodged by the company against the company by a major customer, which has not been provided for. And that's your answer there. That's an example of an emphasis of matter paragraph. So your answer is unmodified opinion with emphasis of matter. But you have to then explain the rationale behind that. You have to explain the accounting rule, why the accounts are correct. That's important as well. So 1 mark or maybe 1.5 marks is going for saying unmodified audit opinion. So maybe I'll just write it here. And Kylie, so there'll be a mark going for showing that you know the accounting rule in relation to provisions versus contingent liabilities, which is a provision cannot be recognized. It should be recognized if it's probable, and also it needs to be able to be estimated with reasonable accuracy. So on 2 counts they weren't able to do that. So therefore, no provision, no liability recorded or expense and expense recorded in the accounts. Then, however, look at materiality, and it involves substantial amount of major customers, so is material. Therefore, it should have been disclosed in the notes as a contingent liability. So that's what a contingent liability is. It's it's a potential liability which doesn't meet the criteria to be recognised as an actual liability, so it's disclosed in the notes. So that shows the rules, maybe 2 marks out of 4 going for that, and then the other 2 marks going for saying the financial statements are correct. A non-modified opinion, write down what that is. In our opinion, the financial statements are true and fair, to show what that means. And then another mark going for emphasis of matter paragraph, and explain what that is, which draws readers' attention to the material matter disclosed in the note, whatever it is. And then the emphasis of matter paragraph does not affect the unmodified opinion. It's good to show that. You show the examiner that that it means it doesn't affect the clean audit opinion or the good audit opinion or the unmodified audit opinion. So the next type of scenario is another information paragraph, where the accounts are true and fair, but readers need to be told that there is some problem with other information outside the accounts, such as inconsistencies with the chairperson's reports. And I think I spoke about this in the previous video, so I don't want to spend too long, but the auditor is responsible for auditing the financial statements, which are these 10 pages in Glanby's annual report. And the other information is everything outside of that. So there are 217 pages in this annual report. The auditor is only responsible for these 10 pages here. However, they have a responsibility to look at the other information and report if it's inconsistent. And they do that in the report here, where they say this is the audit report for Glanbia, and they explain directors are responsible for other information, which includes any information other than the financial statement. And our opinion does not cover this. However, our responsibility is to read the other information, consider whether it's inconsistent materially, and then they say here we have nothing to report in this regard. So if there was inconsistencies, this is where it would be reported. The auditors would say this thing here, and then they'd say we have something to report in this regard, and they would say then if it was the chairperson's, or if it was the group managing director's review, for example, that was inconsistent, they'd say that here. They would say, actually, we have something to report. The group director's review is inconsistent in the following way. And where this has come up before, we can see here. Here's a question, and discuss and justify the type of audit opinion you intend to issue for each of the 4 situations above. If we go back up, and you're finalising ROC, net profit is 800,000 compared with 400,000 income statement. And so management did not agree with our adjustment to correct provision, and it says the appropriate adjustments were made in the income statement and the statement of financial position. So the financial statements are correct, but the director's report is incorrect, it's inconsistent. So really in this scenario, the marks are going for identifying that the financial statements are correct, that the director's report is incorrect and why it's incorrect, and then mentioning the responsibility, the other information, and then how that affects the audit opinion. So the answer for this would be something like this, where we start off by saying the financial statements are correct because the adjustments were made to them for the provision for debts, and then say the director's report is incorrect. So that's just saying the situation, and you're really copying what's in the question. Then you say the responsibility, you want to show that you know the auditor's responsibilities in relation to the financial statements compared to the other information. So here, there's the auditor's main responsibility, audit financial statements and give an opinion on them. However, they do not have to audit or give an opinion on the other information. And then other information is any other section of the annual report outside of the financial statements, the income statement, balance sheet, notes to the accounts, cash flow statements, statement of changes in equity. You don't have to list them all, but that's the financial statements. And the auditor must read the other information and states if it's consistent or inconsistent. And that's your responsibility. So there's maybe half a mark going for that, maybe a mark and a half going for that, and probably 2 marks going for this. A mark where you say it's unmodified audit report and show that you know what that is. In our opinion, the accounts are true and fair. That's clearly an unmodified audit report. It's a clean or audit report. And then say in the other information section, the auditor should highlight the inconsistency. And then that doesn't affect, maybe you could say that doesn't affect so sometimes I just say report or opinion, so it's an unmodified opinion really, I suppose. Not a biggie. Okay, that's that one. Here's another example of the same issue where the other information is incorrect. So the chairman's statement, so you know that's other information, states profit is increased, but it's saying profit is only increased by 3%. So it's the same, it's a different question here, but it will be the same process for your answer. You'd say the chairman's statement is incorrect or inconsistent. It's given a picture of 26 increase in profit when actually it was only an increase of 3. You'd explain the auditor's responsibilities in relation to other information, and then you'd give a non-modified audit report, and then have another information paragraph where you state that the chairperson's statement is inconsistent. So the next type of important or next type of addition to a non-modified audit report is where there is a material uncertainty, some doubt over the going concern basis. So the accounts are being prepared on a going concern basis, which means the directors believe that the company will continue in existence for the next 12 months. But there is some issue in relation to that needs to be, as I said before, managed. And if that's the case, the directors have to disclose, or in the notes to the accounts, mention this issue. So the accounts are true and fair, but please read our paragraphs. So this used to be covered under an emphasis of matter, but now it's just a different name for it, material uncertainty over going concern. But really it's the same thing as an emphasis of matter paragraph. So all we're doing is the auditor is highlighting the going concern issue that's correctly disclosed in the notes. So therefore the accounts are correct, they're true and fair, it's unmodified, but we have to add in this paragraph called material uncertainty over going concern. So here is an example of the AIB, the Allied Irish Bank's audit report on the financial statements for the year ended December 2010. So the auditor says, in our opinion, the financial statements give a true and fair view for the year ended. So an unmodified audit opinion, also known as a clean audit report. So everything is okay with the accounts. The accounts are, prepared in accordance with the accounting standards. However, down here they say emphasis of matter, paragraph, going concern. Now, it previously was called emphasis of matter, as I said, but now we just say, instead of emphasis of matter, material uncertainty over going concern. And it's the same thing. It's an emphasis of matter type paragraph, but we just call it material uncertainty. So, informing our opinion on these financial statements, which is not qualified. So that's important. They're saying this does not affect the clean or the unmodified audit opinion given above. And they're saying we've considered the adequacy of the disclosures, which are political market risks and uncertainties over the Irish banking system, which may cast doubt about the ability to continue as a going concern. And so what they're saying is here that there's a note, and the directors have discussed the material uncertainty. And so read this, and it's a bit like buyer beware. You've been told about this, so it's up to you now to make a decision if you want to keep your shares in the company or buy shares in the company. We've told you that we believe the company, we agree with the directors, the company's going concern, so therefore the accounts are true and fair. But just look at the note or the base of preparation which discusses a material uncertainty, which we think was disclosed properly. This comes up in question. So here's an example here of a question. So the finance director agreed some additional disclosures in the financial statements in respect of going concern. And a material uncertainty is something like not having the overdraft facility being renewed. So therefore, if it was not renewed, the company may not have a liquidity problem, and sometimes short-term liquidity problems can turn into potential going concern or liquidation scenarios where if a creditor is not paid, they can apply to have a liquidator appointed. It says here the directors are currently in negotiation with different banks and they're confident, and then you've obtained adequate evidence about the going concern situation. Now, on the basis of that alone, it could be a bit clearer, but you might have to qualify your answers. So if we just look down here. So, number one, we agree with the base of preparation, i.e. the going concern basis, and we agree with the adequacy of the going concern disclosures the finance director has made. So really your answer then should say that the accounts are correct, the going concern basis is correct. So a non-modified opinion, the accounts are true and fair. In our opinion, the accounts are true and fair. And then mention that there is a material uncertainty which has been correctly disclosed. So the auditor has to discuss that in the audit report. So your answer then, they agree with the going concern basis and the adequacy of the disclosure. So that's what it tells us as stated in the question. So we know then that the going concern basis is correct, and then we know that the disclosures are correct as well, or the note is correct. Therefore, the financial statements are correct. And the auditor would issue a non-modified audit opinion. In our opinion, the financial statements are true and fair. Now, you could mention materiality here, perhaps, yeah, probably best to mention materiality, So I have a habit of saying, and I've said something I shouldn't have. But anyway, so it's a material matter. It's in relation to going concern, and it's been disclosed properly. So materiality didn't matter so much in this one. It's more relevant for other ones, but no harm to mention materiality. So the financial statements are correct. In our opinion, the accounts are true and fair, unmodified audit opinion. And then, so a mark going for this area here probably, and maybe mention material, that it is important. A mark for unmodified audit opinion, and then showing that you know what that is. In our opinion, the accounts are true and fair, because a lot of people will write that down and they mightn't know what that means. And then the auditor should add a paragraph called the material uncertainty, and then half a mark going for saying it does not affect the unmodified opinion, and then something that says what it does, which is just to draw the reader's attention. And that's it. The fourth type of other kind of paragraph that can be put into a non-modified audit report is a key audit matter for listed companies only, and they're a selection of the significant matters discussed with the board, and they're the matters where probably the auditor has identified have the greatest possible risk of misstatement, and therefore they devote most of the resources, not most, but they're the ones where the most resources were expanded on during the audit. And a key audit matter is something, though, there was potentially a risk of misstatement, but the auditors believe that it's been accounted for correctly. Therefore, the accounts are correct, and it's a non-modified opinion. So that's why it says here, key audit matters cannot be an item that cause a modified opinion, which is where there's a qualification, adverse, or disclaimer. So it's just the risky items in the accounts that we've looked at a lot as auditors, and they're accounted for correctly. So it's just letting the readers know what were the big issues for the auditors. And an example of them in Glambia's annual report for 2018 were intangible assets and acquisition, provisions for tax provisions, impairment of intangible assets, and revenue recognition. So all areas where there is quite a lot of potential for misstatement, and the figures are quite big. Acquisition audit matter. The question would have to say, during the audit, the auditors devoted a lot of time on, for example, revenue recognition, and discussed the issue with the directors and the audit committee, and they believed that the revenue was recognised correctly in the accounts. Therefore, it's a non-modified audit report, but revenue recognition should be just highlighted as one of the key audit matters. I don't have an example of that in a question. And the last one is where there's a separate report to management. So here it's an unmodified audit report. This is an outlier. It's different to the first four. Number 1 to 4 there were extra paragraphs to a non-modified audit report. This is not an extra paragraph. It's a separate report. So it's still an unmodified audit report. In our opinion, the accounts are true and fair. And that's all. No other thing gets put in the audit report, but the auditor sends a separate confidential report to management after the audit, and usually it's on internal control issues that may cause problems to the accounts in the future. And I suppose it may be mentioned if it was a key audit matter, because the key thing is there's an internal control weakness. It hasn't affected the accounts yet. So the accounts are correct. So it could be a key audit matter that was addressed, and then the auditors feel they need to highlight the issue to management separately, so that because they believe it may cause problems in the future. So here is an example. I'll just explain modifications, changes, further action. Slightly different, but anyway. So number D there, a major control deficiency, substantial profits of the company. So it's not saying there's any issue with the accounts or the financial statements. It's just saying that there are these potential for massive losses. So therefore, this is an example of a unmodified audit opinion where you say the accounts are true and fair. In our opinion, the financial statements are true and fair because the accounts are correct. But there's an internal control issue that should be reported separately to management, or else reported perhaps as a key audit matter. So the internal control deficiency, it does ask in the question for further actions, which is something we haven't seen before. If you see in respect of each of the matters, consider what further action your firm should take, and then changes to financial statements and modifications to the audit report. So further actions, normally it's to find out more about the issue, but here we've already written so to the director, so discuss with the financial director about the response or lack of response, develop, perhaps you could say, some recommendations to reduce the threat of losses, future losses, and maybe you could say segregation of duties or more supervision of the trader, and then get a reply in writing from them as the director, the financial, about the issue, because it's good to get something in writing and then tell them you're going to issue a separate report to management. So that gives them time to either maybe address the issue or not, or say, give them some, you don't want to damage the relationship, the professional relationship you have with the financial director perhaps. So that's all common sense type things, further actions. Further. Okay, then more normal, or the rest of the answer then is, so a mark or two, mark and a half maybe for that, and then so say it's an internal control problems, and say that the financial statements are correct. It appears internal control has not caused any problems, so therefore the auditor would issue an unmodified audit opinion. In our opinion, the financial statements are true and fair, because that seems to be the case. It could mention a key audit matter. It could be listed in the audit report, if only if this is identified as one of the most significant issues, and that the auditor believes or has reasonable assurance was accounted for correctly. So it's not clear from what we've been given if it is a key audit matter, but if there was a lot of marks going for it, you get a mark going for discussing that. And then, due to the potential future problems, the auditor should highlight the problem in a separate confidential report to management or the audit committee. Now, this wasn't a PLC, but it didn't say, if it exists, I suppose, or if there is. So that's it. That's your answer to that. So, unmodified audit report, the various options, the accounts. In our opinion, the accounts are true and fair. Emphasis of matter, other information, material uncertainty over going concern, or a key audit matter. They're just extra paragraphs in the audit report. And the last thing was the separate report to management, which is outside of the audit report. So here's an unmodified audit report with nothing added. So in our opinion, the accounts are true and fair. But really in question, if you think it's unmodified, it's probably going to be unmodified with something else, because the marks, the marks are going for showing that there's something else. Either emphasis of matter, other information, material uncertainty over going concern, key audit matters, or separate report to management. And that's it. So you need to have a good idea, because they do come up in questions, and the marks are going for, like I've shown in the answers. So you need to know the different options for the unmodified audit report. So thanks for watching, and I hope that's useful.